Peter Lynch. Peter Lynch came out of nowhere yesterday and did a legendary little interview here with CNBC. Very interesting, right? Peter Lynch, oh my gosh. I mean, just arguably the greatest stock picking teacher you could ever imagine. If you watch some of his old interview clips, absolutely phenomenal. And I've gone through them all before in the past and just absolutely eat those things up. But you hardly see Peter Lynch nowadays, right? And, he's definitely, kind of up there in age, but it's great when you get a chance to see Peter Lynch and hear this man talk and kind of give his opinion on the state of the market, some gems here and there. So I can't wait to get into that one with you guys. Then we'll react to this one. The Fed isn't done raising rates. React to that one, give my 2 cents in regards to that one. And last video we'll watch here is S&P should eventually break out. Katie Stockton, hear what Katie Stockton has to say in regards to this S&P 500. Thanks so much for joining me as always, folks. 26,000 plus subscribers on this channel. I appreciate each and every one of you that are subscribed to the channel. Thanks for being here. Hope you guys enjoy this one. It's going to be a good one. If you're looking to apply to join my private stock group, the private wealth group, that will be in the description area for an application to join us in there. Alrighty, let's get into this.
A very special guest. Can we call him a legend? I think we're going to. Legendary investor Peter Lynch. He's with us from Boston this morning to share his perspective on the economy, markets, and the work he's doing for the Catholic Schools Foundation. Peter, of course, is the vice chairman of Fidelity Management and Research and advisory board member of Fidelity Funds. From 1977 to 1990, he managed the Magellan Fund, growing it from, you ready for this, $20 million to $14 billion in 1990 at the time of his retirement. Buy what you know is what Peter taught us, and it's so nice to see you this morning, Peter.
Good to be here.
So let's talk about buy what you know. I'm so curious these days how you're thinking about the economy.
Well, I think people, they're investing in individual stocks. It's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really going to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.
Is your sense, though, that the style of investing that you pioneered is still doable and winnable today?
Well, I think looking for something different, looking for something that's a good story. I mean, who would have guessed TJX, a local company, would have gone up 50-fold, or Stop and Shop would go up 10-fold, or Analog Devices, or NVIDIA. I couldn't pronounce NVIDIA. So you have to find a company that's either a turnaround or a company that's going to grow, like Panera or, Family Dollar stores. I'm not saying that buys now, but that's what's made our, Sears is rolled over. So Kmart's rolled over, IBM slowed down. But we've had new companies come along. I mean, that's the nature. You have to be looking for new companies and look at the balance sheet. If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's 2 depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt, no cash. Which one are you going to buy? I mean, that's not too hard to do.
Peter, I watched you closely because I was in the business back then, and I don't know. Do you remember how many S&Ls went from mutuals to stock trade that you made just buku bucks on back then? I mean, I don't know if you missed any of those, and they were all big winners. They're all big winners. They were all big winners back then. What do you think of the financial sector right now and what happened? We saw with First Republic, and I'd just like to get your insight there since you were so good at that sector.
We had a terrible financial crisis in 1991. I think almost every major bank in Texas went under. Bank of New England, one of the oldest banks in the country, went under. It's like, in 08, 09, the banks were doing these no-doc loans and second mortgages and home improvement loans, and people were buying boats with it. Now the banks are being much more careful. So we've gone through other crises. Some banks will go under. 400 went under after 08, 09. Now we have stress tests. I think the banking system has improved. There'll be some companies go under. That's the nature of it. It's nothing 100%. Like, imagine 1980, 81, we had double-digit inflation, double-digit unemployment, and people were the Japanese were going to take over the world. I mean, we were hopeless. I mean, there's always something to worry about. I'd really, in my over 50 years of doing this, I think I'd be worried if there was somebody didn't bring up something to worry about. That's the nature of the business.
100%. And so, and I think this is more important, especially for the younger folks, but also some of the older folks that can sometimes get to, how can we put this, cynical? Let's just put it like that, right? Because I think it definitely happens with younger folks and older folks, where they get too cynical. Oh, the dollar's going to die and all this stuff. There's always, it's always the end of America. It's always, we're done. Oh, this is the time we're not going to be the ones anymore, right? This is the time we're going to get beat. You got to understand your whole thought process. If you believe that, this isn't the first time it's been like that. It's been like that for over 100 years now. Every single time. They thought Japan was going to take over the world and like Japan was going to run everything back in the 80s. Like that was the talk, right? And now we're looking at that and we're like, really? Japan was going to take over the world? They were going to run everything? Like, are you kidding me, right? No disrespect to Japan. Awesome country, I'm sure, right? But let's be honest, like they're not even, remotely close to as important as, let's say, the United States is, or China, or, Europe, or many other various places, right? And right now, the whole talk was, China, and now there's the worries about, China and Russia and, what they could form and, the dollar's going to die and all this stuff, right? And so you just got to understand, like, this isn't the first time. And the more you understand history, the more you understand, oh, this isn't the first time we've gone through something like this. And it's actually a way more timid version of whatever we're going through, right? If you look at the Great Financial Crisis, people called that the worst recession since the Great Depression. And, you could make an argument, but at the end of the day, when you really looked at it, was it anything even remotely close to the Great Depression? No, it wasn't. Like, everything we kind of go through nowadays is nothing compared to what they would have gone through in the past. When you look at what we went through in the past especially in a high inflationary environment, like he speaks about at the end of the 70s, beginning of 80s, right? Double-digit unemployment with double-digit inflation all simultaneously. I mean, that's a whole different dynamic than what we're dealing with. And we've been dealing with high inflation, no doubt. But there's a big difference between what we've been dealing with versus, that past time period. If you ask me, like, would I rather go back to that time period or be in this time period? Definitely this time period. It's a lot easier to navigate this one, I can tell you, than that past one. Okay, so these are just things to consider in the, when you're investing out there, and never get too cynical about all this stuff, because believe me, it's been way worse in the past.
I was joking because I'm a Reagan guy, and I was there. I started at Merrill in 1981, so I remember what happened. I remember my feelings in 1981, and I remember my feelings, how I felt by 1985. Ugly. And you had a tailwind. I had a tailwind because of what we did. We're not going to do that again. We're not going to cut taxes. We're not going to stimulate the private sector. We're kind of headed the other way. Did you have a tailwind? Will we ever have a tailwind again with this generation?
Well, we've had 13 recessions since World War II, and we've had 13 recoveries. Maybe we're going to have one. If this is a recession, it's probably the most predicted one ever. I never know when we're going to go. I'd love to know the future. I think it would help. I'd be a better investor. I'd pay $5 extra for next year's Wall Street Journal. It would really help. I cannot predict the future, but this recession is so expected, so predicted. Maybe it's coming. I don't know.
Yeah, you could tell Peter Lynch's age when he says, I pay $5 extra for the Wall Street Journal there, right? Brilliant. And, I want to say one last thing before we move on from this Peter Lynch post. Obviously, I look at him as even a better stock teacher than Warren Buffett, believe it or not. And you guys know the respect level I have for Warren Buffett and how impactful I think he was in my life. But I think Peter Lynch is actually above him in terms of teaching stocks, right? And it's so easy for people to get into a mindset of worrying about saving on groceries and this and that, and yet they don't spend, more time researching companies they might be investing into, like he was bringing up at the beginning there, right? And I just that's so vital. You know what I mean? Like, you're investing your money. Make sure you're investing your money in companies that you really believe in for this next 5-10 year period. And I think 2023, and I actually told everybody in the private stock group this last night, I said, I think 2023 is going to be the ultimate year to really see what companies you really want to ride out for the next 5-10 years and which ones you don't, right? Because 2023 is definitely a tougher operating environment, especially in terms of growth. And so the companies that can grow in a year like this, revenues, and have their margins and their net income strengthen as 2023 goes along, that's going to be very telling, because we're not in a hot business climate right now. And that's when you can really, differentiate between the companies that are really truly strong and the companies that are only strong if the business environment is very strong at a particular time. Okay, so yeah, that was, I love it, man. Anytime Peter Lynch can be out there saying something, I think he does, especially people like myself and you guys that are individual stock pickers. I think he's one of the most important folks out there, in my personal opinion, in regards to that. Next one up here: the Fed isn't done raising rates. Okay,
the question on the table about 5 minutes ago, let's answer it. Is the Fed done?
No, the Fed's not done, because the Fed looks at coincident and lagging indicators. So the things it's going to gravitate to are the low level of unemployment in the U.S. They're going to look at some of the tech earnings of the last couple days and say, it still looks pretty good. We need to continue the pressure. So I think they'll do one more. I think it's entirely unnecessary. I think the last rate hike was entirely unnecessary. I think the cumulative and lagged effects of monetary tightening are here. Everything we look at, which is a leading indicator, has rolled over in a massive way.
Leading indicators rolling.
So I was actually expecting to strongly disagree with him, but the more I actually just heard him talk over the last 40 seconds there, the more I actually agreed with him. Yeah, I mean, that's kind of funny. I was expecting to have a big disagreement, but I'm like, yeah, I actually agreed with everything he just said.
When does the Fed get to look at those leading indicators as lagging indicators? When do they start to realize that? Is it the summer, after the summer, September?
I don't know. They must have models, right? Because we look at things like continuing claims. And if you look at the change in 6-month, 9-month, or 12-month continuing claims, they've risen at a rate you've only ever seen in recessions. When we look at the senior loan officer surveys, and you see that 48% of respondents are tightening net credit conditions, it's only been that high in a recession. Then you look at the Conference Board data. You look at Conference Board leading indicators. You look at current versus future indicators. All of those things are in recessionary levels. There are a handful of things that are saying we're in recession right now. If we're looking at them, the Fed should look at them and put some credence behind them.
So you've got a call, I believe, for a rate cut in September. Is that right?
Yes, we do.
What's inflation look like when they're cutting rates?
Well, that's the other thing that's happening. Inflation is rolling over in a massive way. And again, there's a whole range of data. We think by the time they cut rates, it will be below 3% on both the 3 and a 6-month annualized run rate. If we look at things like core CPI, ex-shelter, the trailing 6-month annualized is 1.8%. That's down from a peak of 7.6%. You look at Case-Shiller housing data. From a year ago, home prices are only up 0.4%. You look at the National Federation of Independent Businesses, plans for price changes over the next 3 months are the lowest level, only at those levels in recession. I could keep going on and on and on, but there, look at oil rolled over again, despite the production cuts. So all of these things are happening right in front of us. We look at supplier delivery dates. They're now the lowest. It's the lowest time to receive your supplies since 2009. Recession. The data is right there in front of us.
Ooh.
Since 2009. Recession. The data is right there in front of us.
That was an interesting.
They're now the lowest. It's the lowest time to of us. We look at supplier delivery dates. They're now the lowest. It's the lowest time to receive your supplies since 2009. Recession. The data is right there in front of us.
So that's interesting. Okay. Very interesting. Okay, so I'm going to announce something here that I didn't want to publicly announce for at least like the next 2 weeks. So if you're watching this video right now, you know this before anybody, okay? I'm starting a 5-figure club in the Patreon for people that are in the Patreon Discord. There's going to be like a thing where you can submit once your portfolio gets over 5 figures. If you know, I got the 6-figure, 7-figure club in the private stock group, right? So I'm going to start this 5-figure club. So I ordered the awards, right? Little nice awards, and that were actually shipped to people's homes that hit 5 figures in the market, right? And are part of that Discord. So I order this, right? And at the same company, I pretty much order all my 6- and 7-figure awards. Now, usually, in order to fulfill that order, it takes, usually we're talking about, several business days. Sometimes it's taken in the past even a week. They fulfilled that order in 6 hours. 6 hours and shipped. I had the FedEx confirmation with the shipping, everything shipping-wise and whatnot. Within 6 hours, they fulfilled that order. I was like, what? That's shocking to me. Shocking. And so when he brought up kind of that in terms of, getting supplies from suppliers and all that type of stuff, like that resonated with me because I just thought about that. And I'm like that never was a thing where I would get an order fulfilled from them within a matter of hours. Like it was always, 4, 7, 10 days. Craziness, right? Now, also in terms of the Fed cutting rates, if you know my conspiracy theory, you know my belief is that Wall Street will force the Fed's hand to cut rates at some point this summer. That's my belief in that whole situation. They would have to just shake up the market in a massive way, maybe cause some more banks to go under, maybe have some worse economic data come in, something like that, while inflation comes in month after month after month in the 3s.
Pullback could be in store as corporate earnings roll in. Join us with a technical look on the markets. Katie Stockton, founder and managing partner of Fairlead Strategies and a CNBC contributor. Katie, yesterday, Mike Santoli got my attention when he said that, and it was yesterday morning, so we hadn't gone back below 4,100 on the S&P, but he said that some of the overbought conditions that we've seen in previous when we've gotten to this level, which has been a range, but this has been the high end of the range. This time around, it's sort of been there long enough, moving, churning around, that the overbought condition was worked off, which made me think maybe there's more to come in terms of the rally, which, you've been steadfastly thinking that this is range bound and will eventually head back down, maybe not to the October lows, but maybe to the October lows. Anything better for you yet? I always ask you that. I'm one of these days you're going to say, wow, yes, but maybe not today?
Well, we'll start with the good news. And the good news is that the VIX did break down below the support level that we've been watching. And essentially what that means is that the S&P 500 should eventually break out. As you know, we were watching around 4155 as resistance. And that level should be surmounted. First, we do expect a deeper downdraft. So that's what we're focusing on near term still, especially with resistance having been left intact. And now, as per Mike...
Before we go further here, why is the market being kind of stuck and why hasn't it moved back to, 4,200, 4,400, 4,600 or 4,800 plus where, all-time highs were at? That was well over a year ago. That was a year and a half ago or so, right? The main reason is everybody's been waiting for some sort of confirmation that earnings are going to be in the clear, one, and the second thing is that the Fed's done, okay? And so until you get that confirmation, everybody's kind of, we're just kind of stuck in this limbo of like, well, we can't really tank the market because earnings are actually coming in pretty respectable and decent, and we can't like go to some new number in the S&P really in a major way because everybody's still concerned about earnings and concerned about how if the Fed's going to go further and how much further they're going to go. If the Fed does raise, let's say 25 basis points, let's say they do that, okay, which Wall Street believes they're going to, and they say we're going to, pause and, we think we've done about enough now at this point in time, then that's confirmation from the Fed side, right? So then you don't have to be concerned at all about the Fed raising anymore, so that takes that out of the equation. Then if you're talking about earnings come in respectable, let's say Meta, Amazon, all those companies, get through this quarter and then actually maybe report a decent second quarter with, expecting a strong back half of the year, then you can also talk about, S&P 4,400, 4,600 and going back to all-time highs of 4,800 plus. But you really need those two things because that's really what's clouding the picture right now and making people, I would guess you would say, a little concerned and timid.
are seeing a reaction to that overbought condition. There's a short-term momentum gauge that a lot of technical analysts use called the daily MACD indicator. It's been one of the best market timing devices over the past year or so, and it just turned down for the S&P 500. It was already pointing lower for the NASDAQ 100, and it suggests that this pullback could stay with us for maybe 2 to 3 weeks at a minimum. So we want to stay on the defense for now, but the chances of a higher low, even versus December, the initial support being around 3,800, are now higher given that VIX breakdown.
Were you, you were probably watching crypto and Bitcoin because we talked about.
So she's talking about obviously technicals and the market being in a weaker place for the next few weeks, right? And if you think about it more on the fundamental side, obviously there's a lot of folks that believe in the sell in May and go away. So, you could always get some selling pressure that happens at the end of April in the first couple weeks of May, if that's people's thought process, right? Sell in May and go away. And there's actually, there's a reason it's a saying, because there's a certain amount of folks that believe in that. And so for those folks that believe in that, they're going to sell some stocks at the end of April and they're going to sell some stocks at the beginning of May. It's not everybody in the market. I can tell you it's not me. It's not like I'm like, oh, I got to get out of this market. But I can tell you there's definitely a fair amount of folks that actually believe in that.
Last time it kind of, in your view, had moved above some significant levels, indicating maybe it was at least going to hold those levels, not go back down. I don't know, at one point we were talking about below 20,000 again. It's up 8% today. So it initially backed off to, I think it got low 27,000, maybe below, but now it's back almost to 30,000 just in the blink of an eye.
The volatility is amazing there, isn't it? And we have seen, a base breakout from not just Bitcoin, but a lot of the altcoins as well. And that is an intermediate term positive. But we still think that risk is heightened there short term. We're not a buyer. We're certainly not a buyer into an 8% up day. And we say that because there are overbought conditions, and with volatility so high, especially with equities poised to also pull back, to which Bitcoin is positively correlated, we give it some room. The former breakout point is around 25,200, so that becomes our initial gauge of support for Bitcoin.
We didn't get to talk about the 10-year and yields enough last time, but I think you said we are still in an uptrend for yields, and if 4% is probably going to happen again on the 10-year, that is very significant, because if it were to stay here, I just don't see any way the Fed can feel that great about what it's doing.
Yeah, I don't disagree. With the yields, we really had to focus on each individual time horizon. Short term, to us, they look a little bit higher. Intermediate term, they look sort of sideways to lower still, but within the context of their long-term uptrend. So it's a matter of reconciling those time frames. We do expect treasuries as an asset class to do better in relative strength terms versus equities. And we've already seen that to some degree, some stabilization in relative performance. So we think they're a very viable asset class at this time with.
Cool. Yeah, no opinion on this, folks. Hope you enjoyed this one. Thanks for joining me. And Peter Lynch, if you haven't got to brush up on a lot of Peter Lynch stuff over time, search into YouTube right now. Peter Lynch old interview, or Peter Lynch interview 1980s, Peter Lynch interview 1990s, and you'll find some great stuff that you absolutely love. Okay, it's definitely worth your time. So appreciate everybody joining me as always. Thanks so much. Thanks for being subscribed, folks. If you're looking to apply to join my private stock group, private wealth group, and you're looking to get in there this week, check out the description area. That will be for the application. Much love and have a great day.